Hello financial fans, welcome back to another stock analysis. Today, we'll be covering Newmont Corporation, stock ticker NEM. Newmont is the largest gold mining company on Earth. Currently it has a $40.65 billion market cap, and in 2021 they generated a revenue of almost $12.2 billion. The dividend yield is sitting at 4.27%. And according to their annual report, the dividends change according to the free cash flow and the gold price. On the bottom left, you can see a picture of where their mines are located currently. These places include Africa, Brazil, North America, and Australia. 45% of their revenue comes from North America. Following up is 22% from Australia, 17% in South America, and 16% in Africa. Newmont mainly mines gold, and it makes up 86% of their revenue from products. Following up is 6% from silver, 4% zinc, copper and lead at both 2%. To determine the final valuation of Newmont, we'll be using a margin of safety at the end of our valuation. This margin of safety will be based on financial ratios, financial health, and the growth of the company. Standard margin of safety will be 25% and can either increase or decrease based on a scale that we'll be using. When we're using 4 colors in our scale, bright red will mean 5% increase to our margin of safety, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction. When we're using 3 colors in our scale, bright red will mean a 5% increase, orange will mean no change again, and bright green will mean a 5% deduction. First ratios that we're going to look at are the EBIT growth and the margin growth. As you can see, the EBIT has fallen from 2012 until 2015, but then it actually went up again, going to $2 billion in 2021. During this time, the average growth was 4%, meaning no change in our margin of safety. The margin has also dropped, similar to the EBIT, but also it has regained itself partially, sitting at almost 17% in 2021. Here, the average growth was actually minus 1.37%, which means an increase of 5% to our margin of safety. The next two ratios are the dividend growth and the payout ratio. The dividend, as we spoke about earlier, is connected to the free cash flow and the gold price. In 2012, the annual dividends per share was still $1.40, but it dropped to only 13 cents in 2016. The years following, it actually went up again, going from those 13 cents a share to $2.20 a share in 2021. The average growth during this time was 37%. This high ratio is because it went down a lot, but it also increased a lot after. Looking at our scale, this means a 10% deduction from our margin of safety. The payout ratio is sitting at a very high 174.5%, meaning a 5% increase in our margin of safety. The final two ratios that we're going to check are the debt to EBITDA and the return on invested capital. To determine the debt to EBITDA ratio, we have to take the debt, subtract the cash from it, and then divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes to pay off all the debts. In this case, it's 27%, which means around a quarter. This also means a 5% deduction from a margin of safety. The return on invested capital for Newmont is setting at a very low 0.72%, which means it's a 5% increase in our margin of safety. Let's go look at the valuation models next to determine the intrinsic value of Newmont. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow going from 2014 to 2021. During this period, the average growth in free cash flow was 50%. Since we're calculating the lifetime expected growth in free cash flow for Newmont, I've gone with a conservative 10% of this average, which means just above 5%. Using this 5%, we can determine the future free cash flow of Newmont, and then determine the terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 8.5%. Summing all the present value of the future free cash flows together, we get a sum of free cash flow of just under $54 billion. To get our equity value, we have to add the cash and equivalents and subtract the total debt. Doing this, we get an equity value of just under $53 billion. To get a discounted cash flow price per share, we just have to divide it by the amount of shares outstanding, which is just under 800 million shares. Doing this, we get a discounted cash flow price per share of $66.47. With the current price of $51.21, we get an upside of $15.26, which is almost 30% upside. The second valuation model that we'll be using is the dividend discount model. I've imported the dividend payouts from 4 years ago to the current year. During this time, the average growth rate in dividends was a big 60%. Since we're once again doing the lifetime expected growth rate of the dividends, I'm going with a very conservative 3%. In this calculation, we'll also again be using a discount rate of 8.5%. Doing the math, we get a dividend discount price per share of $41.29. With again the current price of $51.21, we get a downside of $9.92, which is almost a 20% downside. The last model that we'll be using is the multiple valuation. By looking at companies that do similar business to Newmont, looking at their stock price and their earnings per share, we can determine the average PE multiple of the industry. To get our fair value, we just have to multiply the average PE with the earnings per share that Newmont is generating, which is $1.33 per share. Then we get a fair value of $33.91. With the current price of $51.21, we get a downside of $17.30, which is close to a 34% downside. Let's go look at the final overview of our valuation next. Looking at our final overview, we have imported the discounted cash flow, discounted dividend, and the multiple valuation price per shares. Out of this, we get an average of $47.22. The margin of safety we have determined earlier, taking the standard margin of safety of 25%, adding 5% for the margin growth, deducting 10% from the dividend growth, adding 5% for the payout ratio, deducting 5% from the debt to EBITDA, and adding 5% from the return on invested capital. Then our margin of safety will be determined at 25%. Then the fair value becomes $35.42. With the current price of $51.21, our downside is almost 31%, which means a sell. If you do not want to use a margin of safety at all, we still get a fair value of under the current price of $47.22, which is close to an 8% downside. So even using no margin of safety, for me it's a sell. I hope you enjoyed this video. If there are any companies that you would like to see me cover, please let me know in the comments. Thanks for watching.